Welcome to the next video on the series, and this is the final sum up of the triple zone global economic superpowers, as I call them. Now, when we talk about this, we're talking about, in summarizing all this, we're talking about the debt problem. I keep on going on about the debt problem, but what we have in the US, China and the Eurozone, the debt problem is a ticking time bomb. Now, we've gone over in previous videos that there's 400 trillion, that's being conservative, 75 trillion in world debt, that's 530% debt to GDP, and when we look at, for example, Italy's debt to GDP ratio of 132%, and we look at all the kerfuffle about Italy's problems at the moment, then we can see that the world debt to GDP, 4 times that, should be of major concern to the world economy. Now, what I want to show you is I want to go through a bit more information on the European Union, as well as going over what I see as triggers to the financial crisis to come, and why these are important, especially, I'll sum up later why these are important, especially as far as your investment portfolio is concerned, or your investment strategies are concerned. So if we look at this Statista graphic, we can see that there's a breakup of all the national debts per country in the Eurozone. And basically what it does, it adds up to 12.2 trillion euros. Now, this is national debt. So this is sovereign bond debt. This should concern us about $14 trillion, and there is a dichotomy, a bipolar national debt situation where you've got national debts of pigs countries and the national debt of non-pigs companies, which I'm going to go into a little later. Now, in this debt figure, we've also got to add the household debt figure. We're talking about, if we look in this particular graphic, we're talking about close to 58% of the household of the income household debt in Europe is 58% of GDP. So the GDP is about $18 trillion. So we're talking close to $10.5 trillion worth of household debt. And why is this significant? At the end of the day, a lot of this debt is also held by individuals within the PIGS bloc. And this is important from the point of view that Europe, especially Italy, has already gone into recession. Germany just missed going into recession this quarter. And France is just barely keeping its head above water. So if the German economy goes into recession, the demand for imports from other European countries is going to decrease as they tighten down the hatches and have their own austerity program. So I can see this potential recession getting much worse. So if the pigs countries are struggling at the moment, they're certainly going to be struggling later as the European Union dives more into the recessionary stage. So, and also what we've got to consider, that these pigs countries, their average unemployment rate is close to 10%. As I mentioned before in previous videos, we're looking at 25% youth unemployment. So as they go into recession, what we're going to see is demands on the current account and funding it by deficit, because they're not going to be growing their current account surplus. It's all going to be funded by deficit. So this means that the sovereign bond issuance and demands for the ECB is going to be even greater, which is going to just basically increase the toxic liability of these bonds going forward. So this is where the accumulative debt will start to be a problem. Now, we also need to look on the EU corporate bond market, and in the EU corporate bond market, we can see that there's an S&P report. And in this S&P report, basically they have outlined that there is a major problem in terms of the EU debt. And we can see this article from the S&P Global's rating report that the there's about 5.8 trillion euros, which is close to about $6.5 trillion, rated by S&P, of which 85% is considered from A down to triple B, and 15% is believed to be triple B minus, I mean below triple B, and this is effectively junk status. Well, why is 15% important? Well, 15% is just above $1 trillion worth of pretty bad debt. And I'm sure a lot of that, when we add on top of that, we can see that quite a bit of that's Italian debt. So, but the point I'm making here is that quite often the ratings agencies overestimate what the quality of the bonds happen to be. And I mean this from the point that the ECB has been buying bonds, corporate bonds, which have been AAA, and many of these companies are, as I've said in the previous video, pretty well zombie companies. So when the recession comes and the ratings of these bonds are potentially going to come under pressure, and we might see some fallen angels coming from the triple B side of things on the investment grade side bonds being downgraded, and this will swell the size of the junk status to come. Now, let me just go through as well in the Reuters back in early 2018. Reuters also mentioned that there are significant risks in the European corporate bond market. Now, let me read this out to you because this is quite important. There's a big vulnerability in the corporate bond market at the moment, said Mike Riddell, fund manager at Alliance Global Investors, which manages 498 billion euros worth of assets. So they're not a small player. In Europe, the ECB has been helping the market out. And in the US and in China, leverage is quite high. If you strip out the tech companies like Google, Apple and Amazon that are sitting on massive cash piles, the numbers are far worse. So what we're sitting on is a potential credit crunch with institutions and or companies where the corporate bonds may just go belly up, and it's important to consider in that. So what we're seeing is that when we start looking at Europe, and I know I keep hammering on at Europe, but I believe Europe is one of possibly the trigger to come. When we look at Europe, we've got to look at the EU debt sustainability. So we have a two-tier debt system. We've got the pigs, as I said before, pigs and non-pigs. And the pigs are effectively straitjacketed because they effectively, when the recession comes, they can't print money to offset their deficits. What's going to effectively happen is that they have to, as I said a few minutes ago, they have to borrow more money to cover their deficits. It's not likely that they're going to cut spending because, for example, Italy was going to have a 2.7% increase in its budget, in its GDP, and somehow miraculously it seems to be okay at 2.2%, but it's still very high in comparison to what the Germans required in their austerity process. So the demands on this side of things are going to go up basically. So the demands, as I said, for debt issuances by the ECB are going to go up. Well, if Germany also goes in, but Germany's in more cash flow positive position, it doesn't have to issue debt. So therefore the burden falls on the non-pigs economies to bail out in terms of ECB issuance of bonds, the non-pigs companies. So it really is becoming a debt spiral. And that doesn't look good. And this is why we've got to look at the EU debt sustainability, the payment of it. Now, even though the debt to GDP levels look fairly stable, they've been hovering around the 60% level for the last few years. Slightly have improved. We're looking at the situation where the affordability, the EU debt sustainability, the Germans are paying negative interest rates. In other words, people are losing capital in buying German bonds and bonds in the Eurozone, whereas they're paying 3-4% for other more at risk sovereign bonds, Greece, Italy and Spain, and they're probably going to be paying more than that. So the actual cost of debt financing is being borne again by the pigs countries. So this is going to cause major problems going forward. So what does this mean? It means that in this sort of environment, can rates ever normalise? If they do normalise, then Italy, Spain, Greece, which already is a basket case, they're going to suffer tremendously bad going forward. So why is the trigger more likely to come from Europe? Well, it's going to come because the EU is a political construct. It's not like a nation that's homogenous like the USA and China. It's fragmenting. You just have to see it at Brexit. You just have to see what's happening with potentially Italexit. I mean, the Italians and their populist separatist movement at the moment are gaining strength. We're looking at Spain, which has got its problems as far as the Catalonia and potentially the Basque situation going forward. There's political, underneath the scenes in Spain, there's political movements that are not looking all that good, no matter what political pundits are saying. Now, if say, for example, the Italian banks crash, and that's not wishful thinking or anything like that, that's a potential problem that you must be aware of, then where is 500 billion going to come from if Germany goes into recession? Where's the massive amount of money that's going to be needed to be pumped in just to keep confidence in the Italian sovereign bonds, which which is basically held by the Italian banks? As I showed in a previous video, the amount of the Italian sovereign bonds that are held, I think, is close to 78%. So there's a massive, massive problem just alone in Italy. So the only way Italy as an economy can actually survive if everything does crash and the Germans aren't willing to foot the bill, basically, is to go back and exit the euro. And this is the danger, because what then happens to their sovereign bonds and what happens to the US banks that also hold the Italian sovereign bonds? What happens to the swaps and the derivatives that are based on those bonds as well in terms of security and collateral? So the risk is extremely high that there's going to be a trigger event from Europe, whether it's banking, whether it's debt, whether it's corporate, and you have to keep an eye on that. So I believe that Europe is the potential weakest link in the domino. So let's move on now to summarise a good part of what's probably happening in the US debt side of things. Government debt, 22 trillion, and it's growing. Household debt, 15.5 trillion, and that includes student loans, the car loans, and they're liar loans, if anything, credit cards. So we've got a lot of household debt in the United States. And corporate debt, 15.5 trillion. And as we looked at before, the video on America, we're talking about a substantial amount of that, over a third of that is junk status, and the yields aren't showing that. So we do have a lot of debt there. So we're talking about 54 trillion of liabilities now in the United States. Now, what about future liabilities? And I'm going to touch on a thing here that wasn't before. We're talking about future liabilities of close to 100 trillion. We're talking about Social Security, veterans, benefits, pensions, etc. Now, this is definitely coming up as a problem in the future. But the granddaddy of all the liabilities is derivatives. And the top 25 US banks, which I'll show you a list here, have about 256 trillion of outstanding notional value derivatives. Now, what you might say, well, that's notional, that's bank to bank, and they can write that off. That's true to a certain extent. Some of them can, but that's in an ideal situation, and that's providing that the clearing houses have got enough liquidity to do that. But in a crisis, for example, the Bank of International Settlements basically claims that derivatives, non-bank derivatives, etc., make up 3% of the market. Well, 3% of 256 trillion equates to approximately 10 trillion. Now, look at the balance sheets of these top 25 US institutions, and some of them are European institutions as well. 12 trillion. So a major calamity as far as the derivative side of things is going to wipe out all the bank assets in the United States. So this is a weapon of mass financial destruction, as Warren Buffett has said. And if you don't pay attention to what's happening in the derivative side of things, then you really are starting to look at a bit you know, in terms of not seeing the full liabilities in the US banking sector that really do exist. Now, to highlight this fact, there was a good article in the New York Times, and it was towards the latter part of 2017. Basically, I'll read this out because it's really important, because this is in terms of the banks that you can see in the list. Basically, or if you've seen in the list, there's quite a few European banks like HSBC, Barclays, SBS, the Swiss bank, the British banks and Swiss banks. Now, let me read this out. Really, really important. Banks don't have to disclose to American regulators their holdings of derivatives housed in certain offshore entities. The critical variable is whether the American parent company is legally on the hook to bail out its foreign subsidiary if it gets into trouble. And then it goes on to say the size and severity of this blind spot are hard to measure. One consequence is the United States regulators are unable to grasp the full exposure of American banks to their foreign rivals. Germany's troubled Deutsche Bank, for example, is one of the largest players in the derivatives market, and much of its derivatives trading occurs in foreign markets that are outside the purview of American regulators. This means that they have limited visibility into United States banks' connections to Deutsche Bank. That is a very, very serious situation to be in. So, when we look at it from this point of view, we are in a situation where there is not only do we have the massive foreign debt, we have the household debt, we have the corporate bond debt, and it's the quality of these debts that matter. That we have a problem, but we also have the future liabilities of pensions and derivatives. Now, once the dominoes start to fall, basically, and companies start to go, the derivatives become a problem when the other side of it, the counterpart. Say, for example, a European bank goes down. It's one of the top fields. How are you going to do the counterparty? How are you going to settle the counterparty side of things? The notional value becomes irrelevant, and this is where the liability matters. And then you have the dominoes of all the banks, basically. Freezing up because they don't know where the liabilities are. And this is what happened in 2008. So if you don't think it's going to happen again, watch this space. So the EU banks have got a large derivative exposure. The largest exposure is with Deutsche Bank, and there's been concerns about their derivative portfolios, this article has said. Other subsidiaries of EU banks, we've got the Barclays, we've got the HSBC in the USA. Think about it like this. If their derivatives books go bad, who's on the hook? The US? Europe? The ECB? American investors? Are the banks going to stay liquid? Are the banks even going to stay in business? If the banks freeze up, we're back to square one again in 2008, which could have potentially been financial Armageddon. So there is an upcoming danger of see, this is what goes back to debt. Debt is the main trigger in this side of things, and we've got to be so aware of that going forward. Now, let's look at the problems with China, because China also has its unique set of problems as well.